Welcome back, everybody. It's a big day for crypto as we expect Bitcoin to be having a halving. The supply of new Bitcoin is expected to be cut in half sometime tonight. And while it might be good news for its price, it could be bad news for the miners and other institutions keeping the currency managed.
The Bitcoin halving is like a ticking time bomb that goes off every 4 years, sending shockwaves through the cryptocurrency market. It's an event that has historically triggered massive price surges, but also poses challenges for miners.
The halving is a very descriptive term. The Bitcoin network uses a proof of work algorithm, which means that miners use energy and computation through these special chips called ASICs to validate blocks.
In this video, we'll explore exactly how the halving works and what it could mean for the future of Bitcoin. If you're invested in Bitcoin or thinking about investing, understanding the halving is crucial. It's a mysterious event that can seem complicated at first, but don't worry, I'm here to break it down step by step. By the end of this video, you'll know exactly what the Bitcoin halving is, why it matters, and how it could impact the price of Bitcoin in the coming years. So grab a notepad, get comfortable, and let's dive into the world of Bitcoin halvings together. Trust me, this is one crypto event you don't want to miss. Before we dive into the specifics of the Bitcoin halving, let's take a step back and make sure we're all on the same page about what Bitcoin actually is. Bitcoin is a digital currency that was invented back in 2008 by an unknown person or group of people using the name Satoshi Nakamoto. They described how it would work in a white paper, and the rest is history. Now, one of the key things that makes Bitcoin different from traditional currencies is that it operates on a decentralized network. This network is made up of nodes, which are basically computers running Bitcoin software. Each of these nodes contains a partial or complete history of all the transactions that have ever happened on the Bitcoin network. When someone wants to make a Bitcoin transaction, these nodes work together to validate it. They check things like making sure the transaction has the correct validation parameters and doesn't exceed the required length. If everything checks out, the transaction gets approved and added to the blockchain. The blockchain is essentially a giant ledger that keeps track of all Bitcoin transactions. Each block in the chain contains a group of transactions, and once a block is filled up, it gets closed and a new one opens up. To add a new block to the chain, Bitcoin relies on a process called mining. Mining is how new transactions get verified and added to the blockchain. It involves nodes competing to solve complex mathematical problems using powerful computers. This is known as a proof-of-work consensus mechanism. The term mining is used because it's kind of like how precious metals are mined from the earth. It takes a lot of time and energy. It's called proof of work because solving the encrypted hash takes time and energy, which acts as proof that work was done. When a miner successfully adds a new block to the chain, they're rewarded with newly minted Bitcoins. This reward is what incentivizes people to dedicate their computing power to the Bitcoin network. So in a nutshell, that's how Bitcoin works under the hood. It's a decentralized digital currency that relies on a network of nodes and mining to function. But what about this halving event that everyone keeps talking about? How does that fit into the picture? And what kind of impact does it have on the Bitcoin ecosystem? After every 210,000 blocks are mined. When a halving occurs, the block reward that miners receive for verifying transactions is cut in half. So why does Bitcoin have these halvings in the first place? It all comes down to controlling inflation and maintaining scarcity. You see, unlike traditional currencies that can be printed at will, Bitcoin has a fixed total supply of 21 million coins. Once all those coins are mined, that's it. No more new Bitcoins will ever be created. The halving mechanism is a way to gradually reduce the rate at which new Bitcoins are introduced into circulation. Bruce Fenton, CEO of fintech company Chainstone Labs, puts it this way: one of the most important features of Bitcoin is its limited supply and issuance mechanism. By slowly decreasing the block reward over time, Bitcoin's inflation rate is kept in check. Think of it like a gold mine that's slowly running out of gold. As the easily accessible gold gets mined, it becomes harder and harder to find new reserves. The same concept applies to Bitcoin. As more and more blocks are mined, the reward for mining them gets smaller and smaller. This scarcity is a key part of what gives Bitcoin its value. Unlike fiat currencies that can be devalued through inflation, Bitcoin's limited supply makes it resistant to those same forces. In a way, the halvings are like a built-in defense mechanism against economic manipulation. But the halvings don't just impact Bitcoin's monetary policy, they also have major consequences for the miners who keep the network running. You see, as the block reward gets smaller, it becomes less profitable to mine new Bitcoins. Miners have to work twice as hard to earn the same amount of coins as they did before the halving. This leads to some interesting dynamics in the mining world. While the reduced rewards can put pressure on smaller mining operations, it also incentivizes the development of more efficient mining equipment. In fact, we've seen the introduction of advanced models like the Antminer S21 in response to recent halvings. But how exactly do these new machines change the mining landscape? And what does it mean for the average miner trying to turn a profit? So what happens to the miners when the block reward gets sliced in half? It's a tough pill to swallow, that's for sure. Suddenly, they're only getting half the payout for the same amount of work. It's like your boss telling you that from now on, you'll be working twice as many hours for the same paycheck. Ouch, right? This puts a serious squeeze on the profitability of mining operations, especially for the little guys who don't have the resources to keep up with the big players. It's a classic case of adapt or die in the Bitcoin mining world. To stay in the game, miners have to get their hands on the latest and greatest equipment. We're talking about state-of-the-art mining rigs like the Antminer S21, which boasts efficiencies below 20 JTH. These bad boys can crunch through calculations like nobody's business, but they come with a hefty price tag. For miners who can't afford to upgrade, the post-halving landscape looks pretty bleak. Research shows that those still chugging along with older models like the Antminer S19J Pro are going to have a hard time keeping their heads above water, especially when you factor in the average US hosting rates of just under 8 cents a kilowatt. But it's not all doom and gloom. The ever-evolving world of Bitcoin mining has a way of pushing the envelope and sparking innovation. Some crafty miners are experimenting with techniques like underclocking, which involves running their machines at lower power to reduce electricity costs and boost efficiency. Others are branching out and exploring new ways to monetize their operation, like selling excess heat to nearby buildings or earning some extra cash by helping to stabilize the power grid. It's all about getting creative and finding those alternative revenue streams. There's also a growing trend of miners setting up shop in far-flung corners of the globe where electricity is dirt cheap. Places like Latin America, Africa, and certain parts of Asia are becoming hotspots for mining operations looking to trim their power bills. So while the post-halving world might look a bit different, with a potential dip in hash rate as some miners bow out, don't count the mining community out just yet. They're a resilient bunch, always ready to adapt and evolve in the face of new challenges. But the halvings don't just shake things up for the miners, they also have a profound impact on the bigger economic picture of Bitcoin itself. As the flow of new coins entering circulation slows to a trickle, the scarcity factor starts to kick in. And when supply goes down, well, you know what they say about demand. So, let's talk about how these Bitcoin halvings impact the big picture. It's all about scarcity, folks. You see, every time a halving rolls around, it's like someone turned off the tap on the Bitcoin faucet. Suddenly, there's only half as many new coins flowing into the market. Now, if you know anything about economics, you know that when supply goes down and demand stays the same, or even goes up, prices tend to rise. And that's exactly what we've seen happen with Bitcoin after past halvings. Let's take a little stroll down memory lane, shall we? Back in 2012, when the first halving slashed the block reward from 50 to 25 BTC, Bitcoin's price took off like a rocket. It went from around $12 to over $200 within a year. Fast forward to the 2016 halving, and we saw a similar story. The price climbed from about $640 to nearly $20,000 by the end of 2017. And most recently, after the 2020 halving, Bitcoin surged from $8,687 to a jaw-dropping $69,000 by November 2021. On March 14th, 2024, it set a new record of $73,750, with a market capitalization reaching $1.44 trillion. This all-time high was historically because it was set before the halving took place at the 19th of April in 2024. It never happened before that Bitcoin was creating new all-time highs before the halving, and the expectation is that Bitcoin will set newer highs soon after the current consolidation phase will ending. But why does this happen? Well, it's because Bitcoin is designed to be a deflationary asset. Unlike traditional currencies that can be printed on a whim, Bitcoin has a hard cap of 21 million coins. Once they're all mined, that's it. No more new Bitcoins, ever. This limited supply is a key part of Bitcoin's value proposition. It's often compared to gold, which is also scarce and therefore valuable. In fact, Bitcoin has even earned the nickname digital gold thanks to this similarity. Chris Klein, the COO of Bitcoin IRA, sums it up nicely. Bitcoin's production scarcity is what defines its finiteness, and when reward goes down, supply is constrained. Increasing demand at a time when supply is constrained has a positive impact on the price, which can make Bitcoin alluring to investors. So, as these halvings keep happening, and the flow of new Bitcoins keeps slowing down, the scarcity factor becomes more and more significant. It's like watching a rare collectible become even rarer over time. And as we've seen, that scarcity can translate into some serious price action. But here's the thing. Halvings don't just impact the price in the short term. They also have major implications for Bitcoin's long-term trajectory. As the inflation rate of Bitcoin drops lower and lower, it's now at a record low of 0.85% after the latest halving. It becomes an even more attractive option for investors looking to hedge against inflation. So what does all this mean for the future of Bitcoin? Well, if history is any indication, we could be in for some wild rides ahead. But one thing seems clear. As long as demand keeps growing and those halvings keep coming, Bitcoin's scarcity is only going to become more valuable over time. Of course, the market's reaction is never entirely predictable. Speculation and hype can lead to some serious volatility around halving events, and there's always a lot of buzz and chatter in the lead up to a halving. Experts weigh in with their prediction, and investors start placing their bets. It's like the crypto world's version of the Super Bowl. But buckle up, because the ride is just getting started. When a halving rolls around, it's like the crypto world's version of a gold rush. Suddenly, everyone and their grandma is talking about Bitcoin. The media starts churning out headlines, and social media is abuzz with predictions and speculation. It's a frenzy of anticipation and excitement. And let's be real, the market can get a bit, well, crazy. Volatility is the name of the game in the days and weeks surrounding a halving. Prices can swing up and down like a yo-yo as traders and investors try to capitalize on the hype. It's not uncommon to see double-digit percentage changes in a single day. Talk about a wild ride. But amidst all the short-term chaos, there's a bigger picture to keep in mind. Many experts believe that halvings set the stage for long-term growth. They point to the historical data, which shows that Bitcoin has consistently hit new all-time highs in the months and years following a halving. Take the 2020 halving, for example. In the year after the event, Bitcoin surged from around $8,000 to nearly $69,000. That's a mind-boggling increase of over 750%. And if you look at the halvings before that, you'll see similar patterns of impressive growth. So what's driving this long-term upward trend? It all comes back to that magic word, scarcity. As Bitcoin's inflation rate continues to drop with each halving, it becomes an increasingly rare and valuable asset. Combine that with a growing global demand, and you've got a recipe for sustained price appreciation. Of course, no one has a crystal ball. The future is always uncertain, especially in the wild world of crypto. But many experts are optimistic about Bitcoin's long-term prospects. They see the halvings as key milestones on the path to mainstream adoption and even higher valuations. As Chainalysis CEO Michael Groninger puts it, over time, as people build trust in Bitcoin and see it sustaining, we'll see higher prices as a result of the halving. While the short-term market reactions can be a roller coaster, the big picture suggests that Bitcoin's best days may still be ahead. With each halving, it takes another step towards cementing its position as a scarce, valuable, and enduring asset. And for those who believe in its potential, that's an exciting prospect indeed. All right, folks, let's wrap this up. We've covered a lot of ground today, from the nitty-gritty of block rewards to the big picture economics of scarcity and value. It's clear that Bitcoin halvings are more than just a technical event. They're a defining feature of this groundbreaking cryptocurrency. As we've seen, each halving sets the stage for a new era in Bitcoin's journey. It's a time of challenges and opportunities, of short-term volatility and long-term potential. For miners, it's a call to adapt and innovate. For investors, it's a reminder of the incredible scarcity and value proposition that Bitcoin represents. Of course, no one can predict the future with certainty, but if the past is any indication, these halvings could be laying the groundwork for Bitcoin's next big leaps forward. As Michael Groninger puts it, over time, as people build trust in Bitcoin and see it sustaining, we'll see higher prices as a result of the halving. So as we look ahead to the next halving and beyond, there's plenty of reason for excitement and optimism. But as always in the crypto space, it pays to stay informed and keep a long-term perspective. Don't get too caught up in the day-to-day ups and downs. Keep your eye on the bigger picture, and if you want to dive even deeper into the world of crypto, be sure that you subscribe to our channel. We'll explore some of the key factors in the crypto market. It's the perfect companion to today's halving discussion.